Muted start for Shanghai. Taiwan index is down. Hang Seng is down.
I think there's a good chance there'll be a deal.
24,936, which is the 61.8% retracement of the recent move. So 24,700 on the Nifty, and the Nifty Bank at about 55,570.
I don't think that Iran can sustain a prolonged conflict.
Started off a little slow, but now we are picking up pace, and the bulls would hope that this pace sustains.
Important part is that almost every vertical of inflation has shown a month-on-month fall.
Decision that is replacing the current compensation cess which is levied on sin goods such as aerated drinks, cars and tobacco products.
The day of recovery, we've seen good momentum build up right from the get-go.
Okay, well, early jitters or whatever you want to call it, but no jitters afterwards. The markets rocketed higher, and we are up 200 plus points on the Nifty. Good going. Broader markets, though, are still a little sluggish. There are more stocks down than up, but large caps are doing just fine, as you can see on the Nifty and the sensex. So lots to talk about. This is Closing Bell. We're coming to you from the CNBC-TV18 Moti Rosewal studios. I'm Prashant, Surabhi and Nigel with me. Guys, afternoon.
Hi, good afternoon. Folks, so even as those missiles keep falling on both sides, in Iran and in Tel Aviv and in Israel, markets have simply marched on because it's not just an India-specific rally. You look at what happened in Asia. Yeah. Even the Hong Kong market, which was a little sluggish in the morning, finally ending with a flourish. Europe is up. US futures are up more than 0.5% right now.
Well, that's right. And in fact, the important part today is that 20 DMA in both the Nifty as well as the Nifty Bank, that's got defended. And as we speak, on both those two levels, we're trading above that. So that's encouraging. And as Prashant said, for majority of the trading session, the number of stocks declining have been more than the number of stocks advancing. But I think they were waiting for our cue because in the last 2 minutes, the number of stocks advancing has just moved beyond the number of stocks, declining. So pretty good times there. That's one chart. That's the next chart. And the third one comes up for you, which is telling you why your portfolio actually will be feeling quite good in comparison to the morning. They have kissed each other. And now it seems,
one is,
the advancing ones are higher.
Described.
Okay, that's a very colourful description for sure. But guys, I was just thinking, in any other world, it would be surreal, right? When you know that rockets are being fired by Iran and Israel.
And the advanced declared nations kissing each other.
The high point of the analysis so far. But even otherwise, like I said, it's not just India, it's all over the world. Yeah. I mean, what war, what geopolitics? Yeah. Doesn't look like it.
No, absolutely. It's absolutely the case. And it's tragic what's happening at a human level and all of that. It's tragic, actually. And one just hopes it doesn't, become one big another sort of disaster in terms of loss of lives and displacement, etc., etc. We've seen in so many countries over the last couple of years now. One doesn't hope, but markets, of course, are a different animal in that sense. I just want to make one point. We are at this point, as we begin this edition of Closing Bell, we are exactly at the 61.8% retracement of the decline that we've seen from the high to the low that we saw on Friday. So this is it. I mean, so this is a very short-term way of looking at if there's more momentum. And this is the level we put out, 24,936. We put out two levels, 24,848, 50% retracement, 24,936, 61.8% retracement. This very short move that we had. So beyond that, I think, maybe we do look at, higher levels once again. Immediately 25,100, 25,200, those levels which the market took out for a brief period before selling off, I think come into sharp focus again. So that's essentially where we are at. Let's just quickly run you through, how to position yourself in the last hour. Mitesh is back with us. Mitesh was telling us, that maybe we're in a bit of a range, 300, 350 point range in the morning. If that range is to be, if we go back to that range that you were talking about, Mitesh, we're at the upper bound of that range. What does one do from here?
So, Prashant, actually, we have crossed that first level, which was 24,850. But again, I think, the chart hasn't improved drastically. So we'll assume that this range has just, seen an extension on the upside, which is back to the 25,050 level. To about 24,550, 500 on the downside. So I think the index is not giving clear signals, so you must wait it out. There will be phases when the market is, indecisive in the sense that it itself is trying to build a base for the next move. And in that process, I think, you might be trapped into taking a trade. So I would, just hold my horses. I think the market, the good thing is that the breadth is good, as Nigel was pointing out, it's improved on the positive side, and some of the stocks are positive. So we're trading with a positive bias on stocks, but on the index, I'm avoiding it because I'm not very clear as to what the short-term movement could be.
And the stocks, Mitesh, what to do last hour?
So the PI Industries is one of them. I think that's opened with a gap up today and then has sustained. That's a buy with a stop at 40.80 for targets of 4,300 or thereabouts. And the other one which I like is Policy Bazaar. I think that's a stock which did very well, rallied, and then kind of came to some kind of a consolidation, but now it's again picking up. So we'll take a tight stop at about 1887 here and look for a target of around 1965.
Okay, got it. So those are some individual stock level trades as well. Mitesh, thanks very much for that. By the way, it's not just baby fintech. Some of the insurers themselves, those stocks are doing quite well. On the Nifty, if you see SBI Life, HDFC Life, these are among the top 5 gainers on the Nifty this afternoon. The broader point is that the move that we're seeing today, it's important to note that it's not a narrow move, definitely not in terms of market cap. It's not even narrow in terms of sectors. It's not like 4 IT stocks and 2 banks are taking the Nifty higher. It's very, very diverse. Ultratech Cement in top leadership position. The life insurers, like I mentioned, there are a lot of global-facing commodity players that are doing well today. JSW Steel would be an example. There's Trent, there's Infosys. I could go on. Long list of winners today. It'll be best perhaps represented in the sectoral heat map. Let's see if we can put that up on the screen, because a whole range of sectors are rising higher today, from real estate to financials to IT. Let's see if we can get the heat map up in a bit. So the short point is that this is a big, very, very comprehensive move that's coming in. That's obviously the composition chart. And overall, there, look at that. That's what I was talking about. It's all green. It's a wide, market-wide move today. So definitely sort of can't take your eye off it. Well, now that we've shown you all the green, let's talk about the one red that deserves mention, and that's Tata Motors. On such a good day of trade, Tata Motors is languishing. It's down 3.5%. In the morning, it was down almost 5%. And that's because the company has sounded fairly cautious in the investor call that it held. Let's go across to Sudarshan and figure out what the highlights were, because investors definitely are a little worried, Sud, on the Tata Motors commentary.
That's correct. So in a day when market is seeing an all-round gain, one stock that is not participating in the rally is Tata Motors. Its top Nifty loser. It has recovered from lows but still down more than 3%. And the reason is JLR's muted outlook for FY26. Remember, JLR is holding Investor Day meet today, and ahead of Investor Meet started today, early in the morning, JLR released investor presentation mentioning FY26 outlook. So first on EBIT margin, it's saying that it's looking in the range of 5 to 7% versus 8.5% that company reported in FY25. So almost 200 basis points lower margin that company is looking at in FY26. Second, free cash flow. It's saying that in FY26, free cash flow is likely to be close to zero against 1.5 billion pounds reported in FY25. Now, beyond FY26, in FY27 and FY28, company is saying that there might be an improvement on both fronts, margin as well as free cash flow, and medium-term target is to get back to 10% EBIT margin level. Now coming to US tariff issue. Company is saying that regarding the UK exports to US, tariff rate is going to come down to 10% from 27.5%, and company is in engagement with both the governments, UK and the US. But one major export market for JLR is Slovakia, where tariff rate is going to remain at 27.5%. Now coming to another major market is China, where companies say in FY25, while premium market was very challenging, JLR has outperformed the peers, and going forward, to unlock the growth potential, company is saying that it would be via its JV, that is the JLR JV in China, and the first Freelander that company is looking to launch, that is in H2 of FY26. Now regarding the investment till FY28, from basically over FY24 to 28, company is looking to make total investment of $15 billion. But the main reason stock is under pressure today is because of JLR's muted outlook.
Okay, all right. Thanks a lot for that, Sud. So that's the lone stock, actually, that's not been able to recover too much of lost ground from the morning trade. Devin Chokshi, the MD at DR Chokshi Investment, who joins us on the show. Hi, Devin. Good afternoon. Well, JLR has its own issues, and that's why Tata Motors is under some pressure. Though from the recent low, it did have a good pullback. What's your view on the stock?
Hi, Nigel. Good afternoon. I think whatever the negatives are seen, they are all in price as I see it. I think the valuation-wise, the company is comfortably placed. Slightly cautious and muted outlook, agreed. But at the same time, I think few events are going forward, important. They are launching newer models in the JLR portfolio. They are likely to, I think, gain significantly large amount of traction, market share in the portfolio. The demerger of the passenger vehicle, commercial vehicle business portfolios could possibly unlock the valuation potential, I think, which possibly I think is not fully getting reflected into the stock price. That's my second point. Third point, I think more or less the company has completed the program for cost reduction, and that is basically helping them in maintaining the margin, improving margin by some percentage points. So that is again, I think, becoming positive. So as I see it, I think, yes, the company has gone ahead with little muted guidance on JLR, but at the same time, I think most of the negatives, as we see, I think, are in price today. So maybe I think the market could experience the contra buy in this particular account.
Okay, that's a word on Tata Motors. Got that, Devin. Thanks for that call. Let's also focus on one more stock. We've discussed Tata Motors, which has been falling quite a bit today. The other is PI Industries, and PI has been gaining on the back of a positive note that Morgan Stanley put out, saying that perhaps, the worst of the whole chemical cycle is behind us. Maybe things are turning, and at least they seem to be quite optimistic. In fact, they are overweight on PI Industries. Ria has more. Ria, what's the Morgan Stanley thesis?
Well, yes, PI Industries has been in focus today. Morgan Stanley has upgraded the stock to an overweight rating with a target price of rupees 5,000. They've also raised their multiple on PI's agrochem segment to 23 times, and they've raised the segment earnings by 7%, which is offset by the drag in the company's pharma segment. Now, what Morgan Stanley has said is that PI has the highest exposure to agrochemicals in their coverage, and they believe that the company should see a three-pronged volume increase across the domestic exports and the new molecules businesses as well. In fact, they've gone on to say that they estimate that the new molecules and biologicals segment will each comprise a third of the custom synthesis exports and domestic portfolios by FY28. And they think that multiples can re-rate by 20% higher to levels that were seen between 2022 to the first half of FY24, which was a period of robust exports momentum for the company. So overall, for the industry, they're expecting a more constructive volume-led agrichem cycle in 2026, which is also going to support stronger asset runs and operating leverage-led margin tailwinds.
Okay, all right, got it, Ria. Thanks very much for that. Devin, back to you on PI Industries. I mean, a lot of these chemical stocks have fallen off the radar for so long that you wonder if, if indeed the cycle is turning. What do you think of PI, or is there anything else in the chemical space that you like?
No, certainly, Sylvie, good afternoon. I think the company is definitely showing good signs of growth from current levels. On one side, the input costs have remained subdued, 7x of the situation which currently we are experiencing of sudden shoot up in the price of crude oil, and I think the following impact on the derivatives of crude oil that could possibly derail to a certain extent this kind of a outlook. But otherwise, if you minus that part, which is immediate, I would think that their input cost probably remains in the control in the current financial year, which was not the case in last 2-3 years. Second most important point, I think, is in the area of the custom synthesis in the pharma space, where probably I think we are likely to see an additional turnover contributed into the books by the company in FY26, and that should have the positive effect onto the margins as well as on the top line and the bottom line performance. So reasonably confident about the prospects going forward. However, I think if you look at the trailing valuation, then probably I think the stock appears a little bit expensive. In my viewpoint, I think we'll have to allow a couple of quarters to pass by to make a view on the current financial and the next financials, outlook, and to justify that little expensive valuation at which the stock is trading. But nonetheless, I think one would like to buy this particular philosophy that good companies are never cheap. Maybe probably you're buying this company from the point of view of 2 years since, and that's slightly expensive, but yes, justified for investment.
Look at something like a Camlin Fine. I don't know if there is any news flow or what has changed, but basically it was till about 2 months back, was really a laggard, right? But from 150 kind of levels where it was 2 months ago, and that was a level it was back in 2018 as well. It's basically doubled in the last 2 months. So that is an incredible move that we're seeing here on Camlin Fine. So, big one and big re-rating is what we've seen. Look at something like Newgen. Newgen is coming up, some 8% right now. These are smaller names, but doing very well. Sterlite Tech, of course, I think we've highlighted is a very small name, but big volumes. I think volumes today on Sterlite Tech is the highest. I think they are highest ever volumes on Sterlite Tech today. If I've got this right, going back to 2007, 2008. I don't think we've had volumes this large ever on Sterlite Technologies. So 47 million shares, 48 million shares on that coming through. Maybe we could put out an alert as well. Teamlease is up 5%. Nelco is up sharply, some 5.5%, and so on and so forth. So, big list of volume-led gainers, but not the traditional sector. It's very, very stock specific, something from here, something from there. So it's not a bigger, broader move. Anything on Camlin Fine, Devin, or the sector per se, if you track it?
No, Prashant, I think I haven't seen this company of late, so may not be completely updated with the information, I suppose.
Right. Another thematic idea is, I've heard this from many investors, office. That is AWFIS, and we've had the management with us lately after numbers. Up 6%. Today, 682. They basically rent your office model, and sounds like a great idea. But again, have you looked at this one, Devin? It's not that old in terms of listing.
Yeah, but the last one which I saw was the valuation, and I think, frankly speaking, the valuations are not fully justified in the current price. In my viewpoint, they are sounding to me, I think, fully priced a little expensive at this level. Though the potential and the prospects remains brighter based on the commentary that we have read in this company, I would think that not fully comfortable with the valuation at which I think the stock is quoting today. Maybe today too much of momentum is basically fueling the upside in the stock. But one will have to really see how much this momentum would get converted into the actual profit performance for the company. So we'll wait for a while before making any view on the stock.
All right, Devin, metal stocks have bounced actually quite well today. What do you like from here? Even NMDC, earlier this morning, we were highlighting that there were two notes that came out. One was from Citi, the other one was from Kotak. Both of them were saying that they have a sell call on the stock. They're expecting pricing to come down. They're saying the captive mining, the merchant mines, they're going to be producing more. Case in point being a Lloyd Metal, who's going to produce from 10 million tons. Now they're going to produce 26 million tons, 25 million tons plus. Any view on NMDC or any other stock that you like?
We have been liking the copper commodity in particular, and we also feel that I think even the steel as a commodity probably I think is fetching relatively better price in the global market today. And given the kind of situation in which they are, the cost of energy is remaining low. So input, I think the margins are being protected now with the lower cost of energy. As they see, I think the mix of the renewable energy into the portfolio, the profit margin is showing the uptick in every subsequent numbers I think that we have been receiving. So we remain relatively more confident about, I think, the commodities, the steel as well as the copper, both of them. Of course, zinc and silver has already been talked about. They are actually in a good uptrend, but at the same time, I think I would bet on copper as well as the steel as commodity from investment point of view.
Okay, all right. Got that, Devin. Thank you very much for joining in today and sharing your perspective on the way the market's been moving. And it's been moving higher, really. I have to say, by the way, a lot of stocks. I mean, look at Sterlite Technologies. Remember, Sterlite had a very good run last week as well because there was this BharatNet order, which obviously they're part of the chain at different points. So 15% up on it once again today. IGL is up 6% because it seems that Delhi will not be very aggressive with its conversion to EV targets. So it's benefiting IGL and a whole host of other names, including Galaxy Surfactants, Sheela Foam, Subros, 17% up on Subros. So the broader market truly thriving this afternoon. Okay, well, on that note, let's take a very quick break. We'll come back on the other side. Atul Mehra, fund manager at Motilal Oswal Asset Management, will join in with some perspective.
Welcome back. We have the market, which is doing just fine, 200 plus points in the Nifty, 24,931. Market breadth is also flipped, some 100 points in favor, 100 stocks now. Advantage of 100 stocks, basically. It's that crisscross happened as we were starting the 2:30 the closing show. Atul Mehra is with us, fund manager, Motilal Oswal Asset Management Company. Atul, good to have you with us here. Good afternoon. It's just a power of inflows and more inflows. Very shallow dips, and those dips are bought. This morning when we started, I was wondering that if a potential war in the Middle East cannot lead to some gain in the dollar or a demand for US bonds, I mean, what will? Very little else will. But maybe, as a guest in the morning pointed out, they've not reacted because maybe it's a localized kind of event and it's not going to spread out. At least that's the view the market are taking. If it spreads, then maybe we will see the dollar spike. Otherwise, I mean, all these macro indicators are very well behaved. The dollar to begin with, which are crucial for EM flows.
Yeah, hi Prashant. Good afternoon. Yes, I think there are two factors at play. First is, I think there is this local inflow and strong local sentiment by the dip kind of attitude that we've had from investors across the board. And that's why we're seeing fairly steady inflows continue. So even on the ground, I think sentiment, if we meet investors, if we meet a lot of IFAs, etc., the sentiment on the ground is extremely strong. So I think that is one key factor which is quite supportive of Indian markets. And second is, I think after what we've seen in the last few months, like US was a no-brainer 10-year long only, which is now starting to incrementally get questioned in some shape and form, where people are now looking to, at the margin, diversify away from US into other assets. Now, US being such a large part of global equity markets today, even a small incremental shift away from US will have very large inflows in other parts of the world. So these two in combination is, in my opinion, what is leading to fairly resilient Indian markets. And what we've seen also lately is, if you look at so many liquidity events like block deals, etc., going through, and that is perhaps keeping a little bit of lid on the market because of some amount of liquidity getting absorbed by these blocks. In the absence of these, you would have seen the markets being perhaps much higher than where we are today.
Absolutely. And those blocks and all that paper supply is definitely mopping up the flows coming through. By the way, on the screen, we have important flashes coming in from the Commerce Minister. This is, I think, and he's speaking on a whole range of issues, including the all-important bilateral trade agreement with the US, saying that it should definitely happen by the fall, and they're trying to do a smaller first tranche of sorts, perhaps within the July 9 deadline itself, and also saying that they're, of course, engaging with China on the rare earth matter and looking to call a meeting of all the shipping lines and the shipping ministry itself to understand what the West Asia conflict could mean for us in terms of just freight rates. Anyway, that commentary is on your screen. But to go back to what you were saying, Atul, and I know that no one's really saying it out loud in the mutual fund fraternity as well, but the fact is that, like you said, there's all this paper supply coming in, and the inflows on the equity side are no longer as strong. I mean, sure, SIPs are, but there have been redemption in other sort of funds, and the net inflow number is half of what it used to be at the peak.
Yeah.
Is that a risk?
So, Subhi, what is typically observed amongst investors, like if you look at any kind of history of flows, what tends to happen is whenever you have like a correction from a peak and prices come back to the previous high, there is a natural in terms of redemption cycle that picks up because people want to get off from the bus at the price they came in at originally. So if you look at even this month's equity inflows, while the gross inflows are flat on a month-on-month basis, redemptions have gone up by about 5,000 crores on a monthly basis. So that's why if you look at the net inflow number, it's down by about close to 5,000 crores from 24,000 crores to about 19,000 odd crores. So I think that is something that is really playing out. So the gross inflow remains fairly strong. And what you will perhaps see is after a point in time, after markets like consolidate at the current levels and some of the redemptions are through, the gross to net conversion that we've seen in the past, that start to accelerate again. So the point is that if you look at, I think like I was mentioning earlier, the sentiment remains very strong. You have a little bit of, I would say, in terms of decline in flows. But even now, like most people that we talk to on the ground, the outlook remains very strong on flows as well. So maybe it could consolidate at these levels for a few months' time and start to pick up again.
All right. Hi, Atul. Good afternoon. Good to see you. When the last time we met, we were in the same room where there was so much of buoyancy and so much of interest. What do you think is going to break the back of the market? Because you keep throwing bad news, the dip keeps getting bought into. One would have imagined that maybe going by the cues we have had in 2025 so far, we should have been closer to around 22,000 odd on the Nifty. But actually, we're still holding at 25,000. So what do you think can break the back of the market, one? And two is you all had raised some cash, right? What are your current cash levels?
So I think firstly, when it comes to just answering your second question first, so our funds are in cash depending on fund to fund and depending on fund manager to fund manager. So as such, the fund that I run is less than 1% cash. But we have differing levels of cash at the MC level across funds. So that's to with the second question. I think first, I think when it comes to what could lead to a decline, so the key underlying theme has been on the inflow side, which has been quite supportive on the markets. So I think if you have like 1 or 2 months time where your net inflows get towards net outflows, that is when I think there will be some level of panic that could set in, especially in mid and small caps. Because you haven't seen a time, I think, at least in the last 5 years now, where you had a net outflow on the mutual fund side. Because the key narrative on the markets has been around flows. And if you get like 2-3 months of negative net inflows, then that could really question the near-term buoyancy in the markets. Other than that, I think some of these geopolitical events, if they escalate further, like we have obviously no clue about which way some of these things are headed. But if some of these things escalate and you have a global risk of coming about, that could be another risk factor. Other than that, I think local, if you look at it, the business sentiment amongst corporates is very buoyant. And there is a lot of activity in the capital markets generally in terms of IPOs, in terms of QIPs and so on and so forth. So that is where I think we are in terms of the questions you asked.
I know you can't be stock specific, but can you give us some way to think about what is looking interesting, what is still looking, what themes, micro themes, etc.?
So financials, I think, continues to be the top of the pack in terms of preferred sectors. And what we saw in the last month in terms of the RBI action also was quite robust, quite beneficial for the financials pack. So I think that is one pocket which continues to remain very attractive in terms of valuations as well as business outlook. The second thing I want to highlight is when it comes to, say, some of the more premium-oriented plays like real estate. So what we have seen is lately the sales numbers for some of the premium developers are extremely strong, and what we've seen is within a few days of launch, you had the project sellout really happening. So the premium end of consumption again remains very, very robust. So these two pockets specifically. Additionally, I think telecom also as a sector, there is an expectation in the next 6 to 12 months of an IPO by Jio, for example, and you would also look towards some level of tariff increase happening. And that again remains a fairly robust sector. You have more like a very consolidated kind of market and very high visibility on growth, cash flows, margin improvement from here on. So I think these three remain the top of the line. Incrementally, IT also looks good because you've had a fair bit of correction lately, and stocks are now starting to outperform again. So we should obviously look to in terms of commentary in the Q1 results. But that is again a sector which at the margin is looking good.
Okay, all right. So chasing lots of ideas there. Looking to build on to the portfolios. Just to complete the point that Nigel was discussing earlier on cash levels, for the funds that you manage specifically, what are average cash levels For you?
It's less than 1%. So
Less than 1%.
Less than
Got it, got it. And that explains, you've got so many ideas up your sleeves, so I'm sure that money is getting deployed. Good conversation. Thank you so much for joining in, and we look forward to another one soon enough. Well, that's the view coming in from Motilal Oswal AMC. We have to take a break, come back on the other side, and of course a check on dealing rooms, all the buzz and the chatter with Nimesh, and then some final trading ideas for the day coming up with Mitesh as well.
Welcome back. You're tuned in to Closing Bell. We are coming to you live from the CNBC-TV18 Motilal Oswal newsroom. Well, good time to get you Nimesh, who joins us on the show, to tell us what is he picking up in terms of D-Street chatter. Nimesh, negative news, the dip gets bought into yet again.
Absolutely.
Tell us, what are you picking up?
Absolutely, Nigel. A decent pullback and largely led by IT and bank stocks today. And that's helping the Nifty to gain nearly 1%. I guess today's rally is also backed by some institutional buying. So the flows are positive is what I understand. And there is going to be a small MOC buy as well at leading FID. So last 30 minutes, you might see further reaction in some Nifty names on the back of that MOC. The sector which stands out today is insurance. Big move on those individual insurance stocks today. And those are well bid as well is what I understand from large institutions. So it looks like this is backed by FI buying or institutional buying into insurance names. Technically, 24,800 is the first level to watch on the downside, and then the 24,450 level. So clearly, looks like some bit of momentum seems to be backed by FI buying, and maybe this will get extended to the mid and small cap as well. We're seeing first signs of a bit of outperformance in the broader markets as well today.
Nimesh, in terms of individual stocks, what's on your list today?
Well, the first stock on my list is KPIT Tech. The entire IT has done well, but KPIT Technology stands out. Big gainer today and in large volumes as well. The street is anticipating a corporate development very soon. A potential large order win is the buzz as far as KPIT Tech is concerned. So that's something to track there. The second stock is PSP Projects. Again, some bit of infra seems to be back in focus, and PSP Project stands out largely on back of HNI buying. So some bit of larger HNI interest seems to be back in PSP Projects at current levels. The third stock is GAIL. We saw Morgan Stanley tactical buy in the morning, but there is buying interest as well, is what I understand. And that explains a recovery from the intraday lows in GAIL. For GAIL, the near-term trigger would be the tariff hike, which is well anticipated in the market. So maybe in the next 1 month, the Morgan Stanley report suggests that maybe in a month's time, you'll hear the tariff hike, and that will be positive for GAIL. So that's the trigger there. And last, the two stocks where I'm expecting large block deals very soon. Indian Hotels as well as Vishal Megawatt. Both stocks are up in trade today, but I understand there will be large block deals very soon in both those names.
Wars or oil shocks or anything, the blocks don't stop, right? So we'll track these two names as well on the blocks calendar. Nimesh, thanks very much for that. Well, with that, let's go across to Mitesh and get some final trading calls in for the day. Mitesh, so what would you work with?
Looking at the way the index is slowly positive, that we are not coming off to highs, I think it might be wise to take some VTST calls. So I have VTST Supreme Industries with a stop below 45.04 and target of 45.50, 45.60 can be looked at. A couple of IT names are also doing well. So HCL Tech is VTST with a stop at 1713 for targets of 1715.
All right, thanks a lot for that, Mitesh. Let's talk about a couple of big buzzing stocks. IGL, that's seeing a sharp surge in trade today on hopes of easing in Delhi's EV policy. Sudarshan joins us to fill us in with a quick analysis on that front. Sud?
So over the last few months, there have been several reports related to Delhi EV policy, and now we understand from CNBC Awaaz has reported that Delhi government is likely to ease the EV transition policy and may extend the timeline for that transition. But more than that, what is the most important is Delhi government is also looking to ease the cab aggregator policy announced by the previous government of Aam Aadmi Party in November of 2023. And that policy had aimed at regulating not only cab aggregators but also e-commerce players having more than 25 fleet. Now, Citi also has a note on IGL having buy call and target is 250 per share. It's saying that previous government's policy of transition to entire all-electric fleet by 2030 had dampened EGL's volume growth prospect. But now this new government looking to ease that policy may help volume increase because cab aggregator forms 12 to 15% to IGL's total volumes. Another positive part is the CNG three-wheelers. As per the details that we have, CNG three-wheeler transition is unlikely, and that will be positive because CNG three-wheelers contribute 3 to 5% to IGL's volume. And last part is Delhi DTC bus, for which electrification is almost complete, and that is no more a concern because its contribution to IGL's volumes has already fallen to 2% from the level of 7 to 8% that it used to contribute till few years ago. So overall, it's looking positive for IGL, and that's the reason you are seeing a big up move. It's up currently more than 6%.
Okay, that's IGL explains the big move on the stock. So thanks very much for that. Let's stick with some of the other stocks that are buzzing around today on the back of news flow as well. And the next one is Galaxy Surfactants. There is a Motilal Oswal report, and I think Motilal has taken quite a favorable view on the stock, and the street is taking note of that. We have Upasana joining in with the details. So what exactly is this note saying?
Well, Surabhi, company has held its capital market day in which the company has outlined an ambitious structural growth roadmap for the next 5 years. So now let us look at the key highlights of this. Over the next 5 years, company plans to double its volume and grow EBITDA by nearly 2.5 times while sustaining the ROC more than 22% is what they have highlighted. It also has an internal goal to achieve EBITDA per kg of nearly about 25 by FY30 is what they have said. Now, company expects this incremental EBITDA, mainly 50% of it, to come from organic growth from categories such as hair care, oral care and body wash. Mind you, company enjoys a strong presence in these categories. Around 30% of these EBITDA growth is projected to come from the company's new product portfolio, and the remaining 20% will be driven by the new avenues such as strategic partnerships, collaborations, and various other solutions. Now, Motilal Oswal believes that going forward on the back of this, volume growth will be driven by company's strong focus on R&D, increased wallet share, and even new customer acquisition. It estimates a volume CAGR of nearly about 6% from FY25 to FY27, driven by improving volumes in company's specialty care segment. On the back of this, the brokerage has reiterated a buy rating on the stock with a target price of 3,180 per share. So we can clearly see the stock surging in trade today on the back of this.
Okay, all right. Thanks a lot for that, Upasana. Well, let's hop across to Ekta. She's here to tell us about the pharma export data. Ekta, take it away.
Well, yes, Goldman Sachs has come out with a report with regards to the export performance of key pharma companies in May of 2025. So the export performance on a year-on-year basis for a couple of companies such as Laurus Labs, Blue Jet, Syngene, Sai Life Sciences looks good. Laurus Labs up 104%, Blue Jet up 29%, Syngene up around 23%, and Sai Life Sciences up around 18%. There was a weak to mixed export performance from the likes of Gland, Divi's Labs, and Newland. Gland Pharma was down 24%, Divi's Labs was down 23%, and Newland, according to the Goldman Sachs report, was down around 59%. They have also indicated that smaller companies may show volatility due to shipments bunching up in specific months.
Okay, all right. Ekta got that. Thank you very much for the details there on pharma. Let's bring in our next guest on the show. We've got Anand Tandon joining in to take us through the last lap. Anand, good to have you on. So lots of stocks buzzing around on news, and the market's turned around irrespective of the Middle East conflict. What do you make of things? I mean, overall, the resilience the market is showing. Would you be advising more buying or stay on the sidelines because the market's just marching on?
Well, I assume that most people are already invested in the market, at least those who have an interest in it. And therefore, this is not the time, in my view, to be actually adding up your equity exposure. The market may be a lot more sanguine, but the reality is that the geopolitical situation is beginning to get worse. And I don't see any way that there can be an exit very easily. I mean, at the end of the day, you are likely to have, now with Israel and Iran in the fray, there is no easy ramp off that I can see. without a little more destruction and perhaps an escalation from this stage. So net, while we may continue to ignore the obvious, the fact remains that things are not incrementally getting better. So neither is the global demand getting better, nor are the commodity prices improving in our favor. I mean, one of the major positives for the Indian stock market was that oil prices were low. That is no longer the case, and though they haven't actually reached a danger level yet, and they are still moderate, but the downside is perhaps now not very likely given the destruction in the facilities we've seen in Iran. So net, don't increase exposure in the equity markets. Ride whatever you've got.
But Anand, you have been sounding cautious for a while, right? But couple of stocks you like, couple of pockets of, couple of stocks should be good, right? Should be better placed than others. Taking your point on board that this oil spike up is not very, very good. Maybe the equity markets are not particularly cheap, no ways. But there'll be a couple of stocks. If you could share us some ideas, what you're positive on?
So at this stage, I am not. So first of all, I don't think that it's a good idea for somebody to be looking at individual stocks. Broadly, when you are looking at a macro kind of situation, the best thing is to ride, as I said, the entire market. If you look at the results that have gone by, the larger cap companies have done the best in terms of the earnings growth. Now, one could argue that they haven't performed the best in terms of the stock market. But, the stock market performance is not something that one can predict. It will follow its own rhythm, but eventually it will catch up with earnings. At least that's the model that one works with for the moment, for the lack of a better model. From that context, I think, as I said, just stay with your asset allocation. If you've got X amount in the equities, why simply not buy the index? Because all said and done, that is what it will converge to. Overall, as I said, the small caps have done the worst in terms of the earnings growth. The mid caps have done slightly better, and the large caps have delivered you a 7% earnings growth on a year-on-year basis, which is nothing to shout about, frankly, given the valuation we are at. So, I'm not going to be recommending any particular stocks. There are sectors that one is already overweight on. Your banking, financial sector we've been talking about for a while. Most of them have also run up. So rather than doing bottom fishing, cherry picking at this stage, stay with the investments and just ride it out.
Okay. One such sector where maybe you can argue that at least valuations haven't run up too much because stocks haven't done anything in a while is the chemical space, Anand. And now we've started to get a trickle of positive news. A couple of brokers are getting positive on stocks like PI Industries, Galaxy Surfactants we were just discussing. Do you like anything here?
So the specialty chemical space is, first of all, not a market-moving space. That said, the last time we saw a spike in this was about 5 years ago. And since then, many of the companies have actually gone ahead and increased capacity, and that cycle is now coming to an end. So many companies in the frontline chemical space are now at a stage where the capacities are in place, the capex is behind you, and therefore there is a potential of growth. The challenge, however, will be that many of them are actually export-oriented, and therefore we still have to see where they are going to export to, and whether or not we are going to be up against China, or we are going to be able to export to the larger markets in US and so on. So, but broadly, as I said, from a cycle point of view, they are probably positioned right. And since they haven't done much in terms of the stock market, there is a likelihood that you may actually get some kind of positive surprise in terms of the earnings. Hardly a market-moving sector, but as I said, overall, it is well positioned. It could be an area where you could increase your exposure to.
Anna, and you look at a couple of sectors where you see dips and then that gets bought into. One such sector that comes to mind is real estate. We had Prestige Estates, Mr. Irfan Razak, who joined us earlier today. And when we were having that conversation with him, the stock was down close to 2%. He sounded quite optimistic in terms of going into new markets, taking a 5-6% price increase. And he said demand is fairly good as well. The stock used to be 2,100. It went down sub that 1,500 odd mark. And today from the day's low, it's up close to 4%. Any view on this name or any other real estate stock?
First of all, when do you think that a management will tell you that they are in trouble? So it is very unlikely that you should take positive commentary from managements as anything of an indicator. Why are they, if Bangalore is the largest market, if they are moving out of Bangalore and looking at newer market, why is that? By all means, they should continue to increase their exposure and increase their already market-leading position in the market in their home territory. New markets means new relationships with new governments. new ways to get permissions and so on, all of which is cumbersome. The reality is, I mean, I can tell you about my city, for example, since I'm sitting in Hyderabad, the year-on-year sales in Hyderabad real estate is down 33%. So no, I am not bullish on the real estate. My own view is that, with IT not doing well, real estate will also suffer over time because that's incrementally new IT professional hires are the largest demand creators for property. And that's not happening now. So for me, real estate is not something that I would be overweight on.
Okay, all right. 12 minutes to go for market close. I want to talk about insurance companies with you, Anand, when we come back after a quick break. Stocks are higher. So maybe that coming up. We'll take a break. We are back on the other side. Here's some opinion we got from TVF Capital Advisors. Is Shiv Puri. We spoke with him in the morning, based out of Singapore, foreign investor. And 3 areas: financial services, hospitals, and consumer discretionary. Those are what he likes. Listen in.
Globally, if you look at it, the biggest worrying factor is really geopolitics. And as long as geopolitics remains localized, it doesn't become a global problem, markets are seeing past it because earnings are still pretty good, at least in the West. In some of the big tech names, earnings have done very well. Here in India, you're seeing the last 1 year where earnings have slowed down. But as I look forward, you've seen a few things happen that I think will be quite constructive for the markets. So first is that liquidity in the system has gone up. You've seen the Reserve Bank cut interest rates, cut CRR, and that's an important factor. Second is you're starting to see pickup in rural consumption, which is always a good thing. But I think more than sectors, there's a lot of opportunity on a bottoms-up basis, which is the way we've always thought about investing globally. And if you look at but sectors, financial services, healthcare, especially hospitals, consumer discretionary, are probably 3 areas that are looking pretty good. I don't think much has changed. When we were talking about a year ago, I was talking about the same things. So I think that still looks pretty good. And there are, different pockets of interest. You look at the online recruitment space. There is a particular company that's, continues to do well, and that has diversified its business. So you have to just look at some of these bottoms-up opportunities. But I would highlight those 3 or 4 sectors.
Okay, welcome back. 7 minutes to go for close. Earlier today, I spoke with Alvaro Pereira, the chief economist at the OECD. We spoke about a bunch of things, and this bit was interesting, and that's why I want to play out a quick bit. He thinks that the use of AI and what is coming, and they've released a recent paper as well, could really widen productivity. Productivity gains that US, for example, has compared to the rest of the world, which is a problem. Listen in to this conversation.
The variable that we are not talking much, but I think is going to have an impact on major economies are going to go is the evolution of productivity, in particular related to AI. And so we just came out with a recent report that shows very clearly that AI is called, but it's a rare technology, what is called a general purpose technology that will have a significant impact on the productivity and the production and the organization of work. And we expect, in fact, that this impact is going to be between 1.2, 1.5% per year over the next 10 years in the United States, and a little bit less in many other countries. We think that obviously, if you look at what is happening in the last 2 or 3 years in terms of productivity, there's a big gap opening up between the United States and most countries of the world. The United States productivity is growing right now about 2.5, 2.7%. That has not to do necessarily with AI, but it has to do with the reallocation that took place during COVID. More than 22 million jobs were lost and created. These people usually went to either create their own firms or to larger firms, so productivity went up. There's much larger in the United States, much larger investment, especially in digital technology, much larger than most countries, and this is having an impact again on our productivity. And on the other hand, we also know that firm dynamism went up after COVID. in the United States, and this will tend to boost productivity. Now, if you take this into account, that there's already a widening gap between the United States and most countries of the world in terms of productivity, and on top of this, you're going to have AI, in which the United States are much more advanced in this field. It's very likely that this productivity gap will widen. This will have a consequence for monetary policy, for fiscal policy, and for industrial policy, as you mentioned. So I think this is going to be in the near future, the topic going forward.
Well, that's a slice of a very interesting conversation I had. So you should tune into the all-new CNBC-TV18 Prime, and we bring you insights from policymakers, business leaders, economists shaping both the world and India's future. Every day at 12 noon, we have the Global Reset, which airs. We have the Big C focused on currencies, commodities, cryptos, 1 o'clock, and then Global Lens at 8:30 in the evening. We have Parisha sort of championing that. So lots of new programming on CNBC-TV18 Prime. I think Anand is with us with, of course, on markets. Anand, so just a quick word on the life insurers, as I was saying before we left off. Many believe this is the year for life insurance companies. Valuations relative to history are not that expensive. It's a sector where there is a lot of growth with regards to higher penetration levels, etc. What's your sense?
Well, there is still a long runway. However, the penetration is quite good now. I mean, if you actually look at the number of policies sold, it is at least as much as many of the larger markets. But the only issue is that the numbers in terms of the level of coverage is not very high, which allows you still a value-based increase that is quite likely will continue for a long time to come. The problem is that most of life insurance in India is sold as investment products, and that's not a good thing. There is not enough coverage. But that being said, there is no question that it's a sticky product. Therefore, once you get the client in, you don't lose them very quickly. And that allows companies to actually do quite well. Valuations are relatively cheap. If you take LIC, it's actually trading less than its NAV, as it were. Of course, the change of the new business in LIC doesn't move the needle very much in terms of the share prices. So you are looking at the private sector companies to do better. And there again, the valuations have actually shrunk over the last many years and are on a declining trend. So from that perspective, as and when the market actually begins to recognize reward higher growth again, there should be money to be made in these companies, and they are trading relatively cheap.
Anand, on the point of penetration, the conversation I had recently last week with a private insurer. They're tying up with a public sector insurer, and of course, this is his version. I had to check the numbers, but he basically said, without naming the bank, large private public sector bank, he says. He was asking me to guess what is the percentage of that PSU bank's CASA customers which have insurance coverage. And he told me it's 1%. And I found it tough to believe, but that's another way to look at penetration, right? By the way, basically any insurance, no insurance, only 1% has. So I think we can cut the data in a lot of different ways.
Well, I would imagine that, it depends on what you mean by 1%. It's probably 1% that the bank has managed to sell. It may not be that the client...
No, I checked. And I was surprised. How is it possible? Has to be more than 1%. But I will check. It's unfair to put put that question to you. I will check at my end. I will maybe connect again. Stay with us, Anand. Allow me to just wrap up things, because I think the market is shutting, and we'll just come back and talk more. 24,950 is where the Nifty is at, 220 points higher. So it's about 0.9% in the green. What a difference the session has made, right? It's like as I was saying earlier, it's like a perfect it's a symbolic day and shows the larger trend, which is what? Buy the dip. So sometimes those dips have been a little sharper, spread over a few weeks, but they've always been short-lived. And I think today has been that kind of a day. So early jitters, but very short-lived, and the markets kind of moved on, never looked back. Even broader markets kind of worked their way through, and we end with reasonable gains across the board. Advanced decline is positive, and so on and so forth. I think, as I was saying earlier on the Nifty, you have HDFC Life and SBI Life as some of the biggest gainers. Some of the older economy names, BEL, Ultratech Cements, ONGC were the other gainers. They were Tech Mahindra, Apollo Hospitals, all in the range of between 1.5% to 2.5%. I mean, the only big noticeable loser was Tata Motors with a 4% cut. Everything else on the downside was down less than 1%. And actually, you only had 5 names out of the 50 stocks which end the day in the red today. Guys.
Okay, and for the broader market as well, not a bad day at all, because look at the kind of moves we've got. Gland Pharma 5%, IGL 6.5%. The chemical stocks that we've been discussing, Galaxy Surfactants 5-6% higher. Sterlite Technologies, after winning that BharatNet order, 20% on that stock. Suven Life Sciences, Office, Prince Pipes, I could just go on and on. Short point is that it's been a very good day for the broader market as well, and very well-rounded session with many, many sectors participating. Well, that's where we'll take your leave on this edition of Closing Bell. Many thanks for watching, but do stay tuned. We have Markets Forward coming up next.